are the end result of our accounting system. It's how we take all of our accounting information and provide it in a usable format. Now, in financial accounting, Accounting 2101, our focus is more on the external users that we discussed before. So you're trying to get usable information for those types of individuals or groups. And the information they need and want can be very different from what an internal user would want. Again, you're the president of your company. Do they want to see these financial statements? Absolutely. So it doesn't mean that the two groups don't always need or want to see the same thing, but it does mean that the focus is on a different set of users. So your manager probably has reports that are in that a customer doesn't necessarily want or doesn't get to see. You might want to know what your, I don't know, vacuum cost to make, or your iPad cost, but you won't get that information from Apple. They know that on internal documents. They're not going to give an external user that. But your financial statements are something that's prepared with that external user in mind. These are prepared in a specific order, so it's important that you know that these four things are going to be done in an order. The first one is the income statement. We're going to start with it and work through it, but just to go ahead and name them for you in order. Income statement is prepared first, then the retained earnings statement, then the balance sheet, and last is the statement of cash flows. All right, so up first is our income statement. For all of our financial statements, you're going to have a heading that starts. First, you need the name of the company. It's always the first thing in the heading. Then you're going to have the name of the financial statement. This is the income statement, so it says income statement. And then it has a date, and these are specific. An income statement shows activity for a period of time. Okay, so my heading says for the year ended and the date. Okay, this could be for a week ended, for a month, for a quarter. This is for an entire year. So I need to state that it is for that period of time. We'll see how that can be different for other statements. Now, an income statement only has two types of accounts on it: revenues and expenses. Now, we've already talked about what revenues and expenses are. If you skip that or missed that one, you might want to go back and look at the accounting equation video. We talk about those there. So this is a service business, so they have some service revenue, which is the main component, the reason why they exist. And then they also have some rent revenue. Maybe they had a little building they weren't using, and so they're renting that out. So we put all of our revenues at the beginning. We add those up, get a total. So my total revenues here are $51,000. Then we're going to list out all the expenses of the company. The expenses are listed in a specific order. You notice anything about them? If you look through them there for just a second, you should notice that they are in numeric order from largest to smallest, with miscellaneous expense always being last regardless of the dollar value. Even if it was the most expensive, it will be last. Okay? Other than that, they're listed in largest to smallest order. We add up all those expenses. Okay? For us, that's $38,100. We're going to take the difference between these. If the revenues are still larger than the expenses, we have something called net income. Same thing as profit. If your revenues were less than your expenses, or your expenses were larger than your revenues, then you're going to come up with net loss instead. Okay? So, this is the income statement. This is the starting point. It's where we need to start from or begin. Now, if you think back to that accounting equation, I told you that revenues and expenses were going to eventually go into another account. Do you remember what account I told you they were going to go into? They're going to eventually go into the retained earnings account. So the next statement we have is the retained earnings statement. And the reason we have to do the income statement first is because I need to know net income or net loss before I do the retained earnings statement. Otherwise, I can't do it because it's a key amount that I need to do this statement. So again, we start with our heading. We've got the name of the company, the name of the statement, and again, this is for the activity for an entire period. I want to see everything that happened in this account for the entire period. Again, for us, this is that year. So the very first thing I have up here is my balance at the beginning of this year. So we started, if this was say 2012, this would be January the 1st, 2012. What was the balance? What did we start with? Which would have been the same balance as December 31st, 2011. The ending balance is the beginning balance. If we have net income, that adds to this balance. If we had a net loss, it would deduct from the balance. But it's income, so we add it. And this number came from, let me switch back, our income statement right here. That's why we had to do it first. Okay, so we're going to put it here. We add that, and this is just a subtotal. And then, remember there was a third account in that nice little tree there under retained earnings that I showed you on the accounting equation lecture. There was revenue, expense, and dividends. All three of those will go into retained earnings. Revenues and expenses are right here in this figure. That's the only thing you're going to see on the income statement. Revenues, expenses. Dividends then we show right here. They're going to, again, I told you they act kind of like an expense account. So they're going to deduct from the retained earnings statement. So we subtract them. So in total, my new balance at the end of the year for retained earnings is now $21,900. We added in the net income, we took out the dividends. Now, you can format this just a little differently if you like, and it can look like this. Either way is fine, either way is correct. Your heading is exactly the same. You still start off with your beginning retained earnings balance, but now you kind of give a subtotal to tell me if overall for the period, for us a year, if retained earnings increased or decreased over that period of time. So we've got your net income, we subtract the dividends, so overall we had an increase of $6,900. Now if you had had net loss here instead of net income, then you would not say less dividends, you would actually add the dividends, because the net loss and dividends both deduct from the retained earnings account. But they were different, and that's why we specified less dividends. Okay, they're going to give you, again, if you compare the two, you have the same end result. It's just two different ways to format it. Either way is fine. All right, that's retained earnings statement. That's the second one. Have to do it second because I need this number, the ending retained earnings amount, to go on the third financial statement, which is the balance sheet. Notice, there's the number that we just calculated. If I didn't do that, I could not complete my balance sheet. So, again, we have a heading, company name at the top, name of the report or financial statement, which is the balance sheet. And now it's not a period of time, it is one specific date. And the reason for that is these are ending balances. It doesn't show activity, it doesn't show a period of time. It tells me what's the balance at this date in time. So it's a snapshot, it's like a picture of the company for one specific date and time. So don't put for the year ended, for the month year ended, put the specific date. It's very different. Okay? Now, the balance sheet is all the balance sheet is taking that accounting equation we talked about before and putting it into a statement. Notice, this is what we refer to as the account form of a balance sheet, and that's because it exactly mirrors the accounting equation. On the left are all your assets, on the right are all your liabilities and equity accounts. So A equals L plus E, and that holds true for the balance sheet. Your assets have to equal the liabilities plus equities or you do not balance. The whole point of a balance sheet is to balance. So we've listed our assets here, and there is actually an order to this. We list assets in the order of what we refer to as liquidity, which means how easy is it to convert it to cash. So the number one thing you'll always see on a balance sheet is cash because it is liquid. It is already cash. So you would become more familiar with how these will be listed. We'll deal a lot with assets and balance sheet in the future, but all of your assets will be listed here. You'll add those up, and then you're going to list out your liabilities on the right, total those, and list out your stockholders' equity. Now, be very careful. When we talked about stockholders' equity, or equity accounts in general, because it says stockholders, this must be a corporation, but equity accounts in general, there were two subcategories, capital stock and retained earnings. Under retained earnings, we had three more subcategories, revenues, expenses, and dividends. But you should notice we've already taken care of all three of those to get this $21,900. You will never list revenues, expenses, or dividends on the balance sheet. That's why we had the two previous financial statements. They were listed on those financial statements. So on the balance sheet, you've just got the ending balance and retained earnings after you've already put revenues, expenses, and dividends into that account. You will never list them here on the balance sheet. Okay? So you total up those equity accounts, add it to your liability amount, and then you should see assets equal liabilities and equity. We've proven that accounting equation correct. So yes, we have balanced. Now this is the account form, but there's also something called the report form. And it looks exactly the same, except instead of being side by side to mirror that accounting equation, it's all in one long form. So your assets you list first, then you've got your liabilities and equities, and again you want to tie together that the liabilities and equities and the assets equal, just like the accounting equation. Again, this is report form. It's all in one vertical form instead of side by side with the account form that we've seen. Now I'm not going to illustrate for you the cash flow statement. Cash flow statement, we run a little bit out of time in this semester for me to adequately cover all of the cash flow statement. So we're going to leave that one for the accounting majors. So if you're an accounting major and you're going to go on to intermediate, you're going to spend some more time. And I want you to go ahead and look through the cash flow statement in a little more detail than everyone else. Now, if you are not an accounting major, it does not mean that you should not look at the examples of the cash flow statement in your textbook. You should, and you should get familiar with the three sections. There are three sections of the cash flow, and here's my silly way to remember what order they go in. Oh, it flows is the cash flow statement. Oh, it flows, operating, investing, and financing activities. Operating is everything that deals with your day, kind of your day in, day out, the reason you're in business, things that deal with net income. Your investing deals with the purchase of long-lived assets like land or equipment or buildings, and financing deals with debt and equity, so maybe a loan or maybe selling stock in a corporation. So you need to be familiar with what the cash flow statement is and the sections of the cash flow statement, but not necessarily with constructing one at this point in time. Also, the cash flow statement is last because you need this figure from the balance sheet. 4015, when you get done with your cash flow statement, the whole point of it is to tell me where the cash came in and where the cash went out. And it should give you an answer that you have an ending balance of $4,015. So the cash flow statement's neat that you know the answer before you begin, but you've got to still tie back to that answer to make sure that you have it correct. But that's the whole point of the cash flow statement. For most of our other accounting, we don't follow cash. We follow something called the accrual basis. We'll talk about that later. But for the cash flow statement, you do follow the cash. Where did it come in and where did it go out?